Welcome back to Investing Talk Podcast. Today, we're zeroing in on an upcoming earnings report that's certainly on many investors' minds, Lowe's. We've had a chance to really go through the materials you've shared with us, from analyst reports to market insights, and we're ready to break down exactly what you, our listeners, should be watching for.
Yeah, absolutely. Our mission today is to distill all of that information into, well, a clear, concise understanding of the landscape surrounding Lowe's next earnings call. We'll try to cut through the noise, highlight the most crucial information, and, give you the clearest picture possible without just drowning you in data.
Okay, perfect. And before we unpack all of that, just a quick note. If you find these discussions helpful, informative, please consider subscribing, liking, leaving us a comment. Your support truly helps us keep these conversations going. And hey, if there's a specific company or topic you'd like us to explore in a future episode, just let us know in the comments below. Oh, and if you feel like buying us a coffee, there's a link for that too. All right, let's get straight into the nuts and bolts then. When exactly is Lowe's set to report, and what are the current market expectations shaping up to be?
Okay, so Lowe's is scheduled to report its earnings on Wednesday, August 20, 2025. That's right before the market opens. And when we look at the analysts, there's a fairly tight consensus on the numbers. The general forecast for revenue is hovering somewhere between $23.9 billion and $23.99 billion. Pretty narrow range. And for earnings per share, EPS, which gives us that snapshot of profitability, the consensus stands right at $4.25.
Right, $4.25. And this is where it gets particularly insightful sometimes. Beyond that official analyst consensus, there's often what's called a whisper number floating around. Now, this isn't official, but sometimes it originates from institutional traders or maybe internal expectations, and it can be a pretty accurate pulse on earnings. For Lowe's, that whisper is actually slightly below the consensus. It's indicated by an expected surprise prediction, or ESP, of a near 0.56%. So what does that subtle negative signal potentially tell us?
Yeah, that negative ESP, it's fascinating detail. It suggests that while analysts are largely aligned, some of the more informed market participants, or at least the models tracking them, might be anticipating a slight miss against that $4.25 EPS. It's a proprietary metric, really designed to gauge how much actual earnings might deviate from the consensus. And a negative rating like this means the whisper is leaning a bit bearish. And to put that into broader context, we also have to consider the company's own previous guidance. For their fiscal year 2025, Lowe's had provided a full-year EPS guidance between $12.15 and $12.40. Now, while they didn't reiterate a specific quarterly guidance in Q1, management did highlight ongoing macroeconomic headwinds impacting demand, specifically in their do-it-yourself, the DIY segment, and also large discretionary projects. So that commentary, it sets a cautious tone that this whisper number might be reflecting.
Okay, that makes sense. So given these current expectations and that intriguing whisper number, how has Lowe's historically performed against these kinds of forecasts? Do they have a track record of surprising the market? And if they do, what kind of surprises are we usually talking about?
Well, what's really notable about Lowe's, actually, is their consistent performance against the EPS consensus. They've actually beaten the EPS forecast in each of the last 4 quarters, consistently. So, for instance, in the most recent Q1 of 2025, the consensus was $2.88, right? But the actual EPS came in at $2.92. So that's a positive surprise of nearly 1.4%. This does suggest a pattern, maybe conservative guidance or just really efficient cost management that allows them to consistently clear that bar.
A consistent beat history. That certainly sounds positive on the surface. But a beat doesn't always mean the stock jumps significantly. So historically, how has the market reacted to these Lowe's reports? Do shares typically see a big surge, or is the response usually more subdued, even with a beat?
Yeah, that's a great point. Historically, post-earnings price reactions for Lowe's have been, quite muted to maybe moderately positive. There isn't really a strong pattern of those outsized explosive moves you sometimes see. The magnitude, the direction of the stock's movement, it tends to follow the guidance they provide for the future and, of course, the broader market sentiment at the time. Like last quarter, for example, even with that modest beat we just mentioned, shares were largely flat, maybe slightly positive in the first trading session after the report, but nothing dramatic. It tells us that while they consistently meet or slightly exceed expectations, investors aren't typically caught way off guard by massive upside. It often really comes down to that forward-looking statement.
That's a crucial point. It's not just the headline numbers, it's the underlying health, right? So, beyond those simple EPS and revenue figures, what have the key metric trends been telling us about Lowe's performance lately, especially regarding revenue, EPS, and maybe that sales mix you touched on? What's been driving those shifts?
Right. So when we dig into the key metric trends, we have seen slight year-over-year declines in revenue. For Q1 2025, revenue was down 2%, landing at $20.9 billion. GAAP EPS in Q1 also saw a decrease, about 5% year over year. Their net margin was last reported at 8.22%, which isn't bad, but a truly crucial point, and one that resonates with the company's own commentary, has been weakness in their sales mix. Specifically, their DIY and those big ticket categories, things like major appliances or big renovation projects, they've been under significant pressure. And this isn't just a slight dip. It seems to indicate a shift in consumer behavior, or maybe just their capacity to spend on larger home improvement projects right now.
Okay, it sounds like that sales mix is really a bellwether for what's going on underneath. Now, let's widen the lens a bit. Beyond the pure financial data, what significant news or strategic moves or just macroeconomic factors have been at play during this past quarter? Things that could influence Lowe's performance when they report. What's the broader narrative here?
Yeah, exactly. That sales mix is key. And looking at the quarter, there haven't been any huge internal catalysts from Lowe's themselves. No major new product launches that would dramatically shake things up.
Hmm.
No big mergers or acquisitions either. However, that consistent softness in DIY demand and discretionary project spending, that's been a pervasive sector-wide theme. It feels less about a unique Lowe's issue and maybe more about the broader market conditions they're operating in.
So it sounds like Lowe's isn't just feeling an isolated pinch, but actually the entire home improvement retail sector is navigating some pretty serious headwinds right now, correct?
Precisely, yes. The entire sector has faced challenges from, well, tepid consumer discretionary spending. When people start tightening their belts, those big-ticket home renovation projects, they're often the first things to get put on hold. And then you have elevated interest rates, which directly impact affordability for home loans, financing. That curbs enthusiasm for large-scale home projects, too. Plus, housing turnover, the rate people buy and sell homes, it remains below historical averages. Fewer people moving means less immediate demand for those big renovations, or even the smaller decor updates that often come with a move. So all these factors, they combine to create a pretty challenging environment for project-driven retail activity right now.
That macroeconomic backdrop definitely paints a clearer picture. So how are the professional analysts reacting to all this as we head into the report? Are we seeing a shift in their sentiment or ratings?
Yeah, that leads to an important observation. What's the expert sentiment reflecting? We have seen a bit of a trend where some analysts have slightly trimmed their estimates leading into this report. They're flagging the ongoing risk from that weak DIY cycle and the broader slowdown in discretionary spending. It's clearly on their minds. For example, Zacks, which is a well-known analytical firm, they currently give Lowe's a neutral rating. And they specifically noted a modest downward revision trend in recent weeks. So that suggests a cautious stance, definitely not overly optimistic, from the analyst community as a whole.
Okay. So with all of this in mind, the expectations, the history, the macro headwinds, the analyst sentiment, how has the stock itself been behaving leading up to these earnings? And maybe more tellingly, what are the options markets indicating about the expected price movement? What's the bet there?
Well, the stock has actually seen a relatively strong run-up leading into earnings. It's climbed approximately 14% over the past month. Now, this sharp pre-earnings rally could, somewhat ironically, raise the bar for what investors consider a positive surprise. If the stock has already priced in a decent outcome, a modest beat might not actually be enough to sustain that momentum post-earnings.
That makes sense. The market seems a bit optimistic already, almost like it's front-running the news. So what about the options market specifically? Are investors collectively betting on a big move, maybe up or down, or are they anticipating something more contained?
Yeah, it's interesting. While we don't have explicit call and put ratios right in front of us, tracking tools generally show a fairly balanced open interest, meaning there isn't a heavy skew of bets in one particular direction, not overwhelmingly bullish or bearish in the options pits. What's most crucial here, though, is the implied volatility. That's basically the options market's expectation of future stock price swings. And the options market, if you look at something like an at-the-money straddle, which combines calls and puts at the current price, it's suggesting an expected move of roughly 4.0% to 4.5% in either direction, up or down, after the earnings announcement. Now, this is generally in line with Lowe's historical post-earnings movements. It signals the market is pricing in pretty typical volatility, not some extreme swing. It suggests a certain level of predictability, or at least perceived predictability, for how much the stock might jump or fall, at least in the eyes of those options traders.
Okay, so we've gathered quite a bit here. What does all this accumulated knowledge mean for the upcoming report? Let's try to game out the potential scenarios for Lowe's. What would a truly bullish outcome look like? Something that would likely send shares higher.
Right, the bullish case. Well, It would probably need to go beyond just beating on revenue and EPS, though that's a start.
Yeah.
It would likely require management to signal a clear stabilization, or even better, an actual improvement in those critical areas, the DIY segment and discretionary project spending. And crucially, their forward guidance would need to either edge up their full-year EPS forecast or at least maintain it firmly within the upper end of that prior $12.15 to $12.40 range. Positive commentary on cost controls, effective margin management that would also be essential. It would show they're navigating these headwinds effectively and finding efficiencies.
And what's the flip side? The bearish case that might send investors scurrying? What are the key red flags we should watch for there?
The bearish scenario, well, that would likely involve Lowe's missing on revenue or EPS, even modestly. But perhaps the more impactful trigger would be if they guide their full year at or near the lower end of their range. Or worse, if they outright reduce their guidance. That would be a big negative signal. We'd also be looking for any additional signs of weakness in those key areas discretionary spending, or maybe trends within their professional contractor and business customer segments worsening. Any indication of, say, increased promotional intensity just to drive sales, or further margin pressure from sales deleverage, that would certainly fuel a bearish reaction.
This really brings us to a critical question for you, the listener, as you prepare for this report. If you had to pick one thing, what is the single most important metric to watch? The one that will tell us which way Lowe's is truly headed, maybe even more than the headline earnings number itself. That's a tough one. But if we connect it back to the bigger picture and the specific challenges Lowe's has been facing, I'd say the single most important metric to watch will undoubtedly be comparable sales, same-store sales. And pay particularly close attention to this metric within their U.S. home improvement segment. And drilling down even further, specifically in their large DIY category, given all those recent macro pressures we talked about, high interest rates, sluggish housing turnover, and Lowe's existing sales mix challenges as a comparable sales figure, it's going to have an outsized impact on how the market perceives their underlying business health. And then, of course, a very close second in importance will be that forward-looking guidance for the stock's immediate reaction. But comps tell the story of current demand.
All right, so bringing it all together then, synthesizing everything we've discussed, what's our overall leaning for Lowe's as we head into this report? And, what might that suggest for those of you listening who are looking to make a strategic move or maybe adjust a current position? Okay, the overall leaning, I'd have to say it's pretty neutral. If I had to put a confidence score on it, maybe a 5 out of 10, right down the middle. Because while Lowe's does have that reliable history of delivering those modest beats, the recent run-up in the shares, combined with some of those negative estimate revisions from analysts and that slightly bearish earnings ESP we mentioned, it all suggests that expectations might already be a bit elevated. There just isn't strong conviction for either significant outperformance or a sharp guide higher, especially in the current environment with all those sector-wide headwinds. It feels like a steady-as-she-goes type of report is probably the most likely outcome.
Okay, neutral leaning. So for someone considering their strategy around this earnings event, what are some different approaches you might consider, bearing in mind different risk appetites?
Right, strategy depends on risk tolerance. For the more risk-averse investor, it might be wise to consider just waiting until after the earnings are out to reevaluate any positioning. Given the implied volatility we talked about, that expected 4.5% move, and the lack of a clear directional edge, patience could be prudent. Let the dust settle. Now, for the more risk-tolerant, maybe a short-dated options straddle or strangle could potentially be used. That aims to capture volatility, betting on a significant move in either direction. But remember, options pricing is usually pretty efficient around earnings, so it's not free money. Alternatively, a defined risk options trade, like an iron condor, might suit those who expect only modest movement within a specific range. And of course, if you're already holding Lowe's stock and plan to hold through earnings, just be acutely aware of the risk of a post-earnings pullback, if that guidance or those crucial comparable sales numbers happen to disappoint. Every strategy carries its own risk profile, so really understanding your own comfort level is absolutely key here.
Yeah, absolutely. So whether Lowe's manages to, once again surprise us with a modest beat or maybe confirm some of the prevailing headwinds we've discussed today, it's clear there are definitely several layers to this earnings story that go well beyond just the headline numbers.
Exactly, and I think the real question for you, the informed listener, becomes, how much do these quarterly fluctuations really reflect fundamental shifts in consumer behavior around home improvement? Is this a sustained retreat from that pandemic-era DIY enthusiasm? Or How much is simply tied to more transient macroeconomic factors like those elevated interest rates, which might eventually normalize? It's really about trying to discern the long-term signal from the short-term noise.
Precisely. It's definitely a lot to consider, but we hope this breakdown, built on the materials you shared, has given you a clearer picture of what to watch for with Lowe's. And remember, if you enjoyed this discussion and want more insights like it, please do subscribe, leave us a comment, maybe consider buying us that coffee, and don't forget you can always suggest a company for us to look into next time. Thanks for joining us on Investing Talk podcast, and we'll catch you next time.